Imagine a hospital, but the patients aren't people. They're companies. Some of them can't breathe on their own, can't generate enough profit to pay the interest on their debt, yet they keep walking. Not because they're healthy. Because the system keeps feeding them cheap credit. And here's the uncomfortable part. When the economy is full of these living dead firms, growth doesn't just slow down, it gets misdirected. Capital gets trapped. Competition gets warped. Innovation gets postponed. You don't get a clean recession, you get a long, quiet rot. Tonight we're exposing the mechanics of zombie companies, how they're created, who benefits. Let's define it properly, because zombie gets thrown around as a meme. A common policy definition used in research is a firm that is old enough to have proven itself, often measured as 10 years or older, and for multiple years it can't cover interest expenses with operating profits. In other words, it survives, but its core business can't pay the rent on its debt. Researchers use slightly different filters depending on dataset, listed firms versus broader samples, but the point is consistent: persistent weakness plus persistent survival. Zombies aren't just companies having a bad quarter. They're the firms that would normally either restructure or exit. But they don't. So how do you keep a non-viable firm alive? You lower the cost of survival. When interest rates are low, and refinancing is easy, debt stops behaving like a discipline mechanism. A company that should be forced to change, sell assets, or shut down can instead roll debt forward, over and over. This is not just a theory. The Bank for International Settlements has documented that lower interest rates are associated with higher zombie shares, especially in sectors that depend more on external financing. Cheap money doesn't create zombies out of thin air. But it makes the borderline firms hard to kill. Now we get to the dark plumbing. A zombie firm often survives through something that looks boring on paper but is huge in practice. Loan evergreening. Evergreening is when a lender keeps extending or refinancing a struggling borrower, sometimes to avoid recognizing losses. Because the moment a bank admits this loan is bad, it can hit capital ratios, earnings, bonuses, reputations, sometimes even trigger regulatory pressure. So instead, the loan gets rolled. The firm stays alive. And the economic cost gets deferred. The European Bank for Reconstruction and Development describes this as a core driver of credit misallocation. Cheap credit acts like an implicit subsidy, weakening the link between risk and borrowing costs. That's the key word, subsidy. Not always an explicit government bailout, often a quiet financial arrangement that keeps the machine running. You might be thinking, so what? Bad companies exist. That's capitalism. Sure. But zombies matter because they don't just fail quietly, they distort the entire environment. OECD research shows zombie firms tend to be less productive, and their survival can congest markets, making it harder for more productive firms to grow. Here's what that looks like in the real economy. They keep workers and capital tied up in low-return activity. They pressure prices in unhealthy ways, sometimes cutting prices just to generate cash flow. So how does a normal company become a zombie? Usually it's not one dramatic collapse. It's a pipeline. Step 1, a shock hits. Demand drops. Costs rise. A sector gets disrupted. Step 2, debt fills the gap. Instead of restructuring early, the company borrows to buy time. Step 3, the refinance habit begins. Debt matures, gets replaced with new debt. Over time, the firm becomes an organization whose main skill is staying financed, not staying competitive. Step 4, investment gets cut. R&D slows. Maintenance becomes good enough. Talent leaves. The business gets older inside. And here's the tragic part. Sometimes the zombie phase starts as a reasonable decision, just survive the storm. But it becomes permanent because money stays cheap longer than expected. After 2020, many governments used emergency support to prevent mass bankruptcies and unemployment. That was understandable. But even the IMF warned, ongoing support has a risk, moral hazard and the survival of zombie firms that persist only with continued assistance. The trade-off is brutal. If you let everything fail during a crisis, you get chaos. If you support everything for too long, you freeze the economy into a low productivity state. The ECB has also discussed post-pandemic risks where zombie shares may not explode, but quasi-zombies, weak profitability, heavy debt, can remain elevated. So the question becomes. Now we hit the moment where the horror movie gets real. When rates rise, zombies face a simple problem. Their business model can't pay the new price of money. If your operating profit barely covers interest at 2%, what happens at 6%? You can't efficiency your way out overnight. This is why rate hikes don't just cool inflation. They expose structural weakness. The U.S. Federal Reserve has examined zombie firms and how they differ, often smaller, lower profitability, lower cash, weaker investment opportunities than non-zombies. In other words, when credit tightens, zombies aren't merely inconvenienced. They're tested for viability. And here's the twist. People romanticize capitalism as a clean Darwinian process: bad businesses die, good businesses win. But zombification replaces that with something else. Creative delay. Markets stop clearing. Instead of failure leading to renewal, failure leads to refinancing. And the economy becomes a museum of firms that should have evolved. But didn't. This is why economists care, not because they enjoy seeing companies die, but because productivity growth depends on the flow of resources toward higher value activity. If that flow is blocked long enough, you get an economy that looks stable, but feels stagnant. High employment. Let's keep this practical, without naming specific companies. Here are 5 signals investors and analysts often watch. Interest coverage ratio, ICR, stress. If operating profit repeatedly fails to cover interest expenses, that's a warning sign. Refinancing dependency. The firm survives mainly by rolling debt, not generating cash. Falling capex/underinvestment. Maintenance and growth spending get cut first. Rising leverage with flat productivity. Debt increases, but output per worker doesn't. Maturity walls. Large portions of debt coming due in a short window, especially during tighter credit conditions, turn into a stress event. None of these require conspiracy. They're just balance sheet physics. So why is this topic so important right now? Because the era of effortless refinancing changed. And whenever the price of money rises, the system has to answer a question it postponed for years. Which firms are alive, and which are just financed? If zombies unwind quickly, you can get pain, unemployment spikes, regional shocks, supply chain failures. If they unwind slowly, you can get a decade of stagnation, low growth, weak innovation, fragile households. Either way, this is not a niche accounting issue. It's the hidden architecture of an economy deciding what deserves to exist. And here's the final thought. A healthy system doesn't keep everything alive. It keeps the future alive. Next episode, we'll look at what happens when the bond market stops believing the story, because that's when the real panic starts.